The stock market is up over 10% since mid-October. So what is the outlook into the upcoming FOMC meeting and beyond? Well, back in mid-October, we expected a bounce into a new daily cycle. That implies that this short-term bounce into a new daily cycle will likely be followed by a drop down into another daily cycle as well as intermediate cycle low. That's exactly what happened so far, partly due to a lower rate hike expectation. The 1% hike was previously expected with over 98% probability, and it's now at over 85% probability. The expectation of a lower 75 basis point hike increased from a 1.6% probability to a 14.5% probability. And as FOMC approaches, stocks might still rise a little bit, perhaps into the 50% Fibonacci retracement from all of this intermediate cycle decline so far. But with the intermediate cycle only 133 days long, after the FOMC there will still likely be another decline into the daily as well as the intermediate cycle low. And while the recent low on the optimism index, around 16, is low enough for a usual intermediate cycle low, history might still repeat what happened during the previous intermediate cycle in mid-2022, when the S&P 500 made a lower low into that intermediate cycle, while the optics gave us a positive divergence with a higher low. So if history repeats, if history rhymes, we might see another lower low on the S&P 500 down into the intermediate cycle low, with a bit of a positive divergence, a higher low on the optimism index as it happened during the previous intermediate cycle low. And after the upcoming low on the S&P 500, we are likely to see a bit of a Christmas holidays, a bit of a New Year holidays rally into a new intermediate cycle. But on the longer term, after that New Year holidays rally, there is still a good chance for more pain, unfortunately. Looking at PMI, Purchasing Managers Index, history shows that normal corrections drop PMI down into under 50, this level over here. While currently the PMI index is still above 50. So even a normal correction might still come down noticeably lower. And additionally, the ongoing correction might be deeper than usual. Look at this comparison of PMI versus the Fed rates. We see that Fed hikes, as in 2007, as in 2019, often lead to a significant drop in PMI, down into nearly 40 during the pandemic, or down into 34 during the global financial crisis. And as we know, over the recent history, since the beginning of 2020, the Fed rates have increased significantly with the highest pace over the last 15 years at least. So next year might still bring us a noticeable recession, whether you change the definitions or not. So with that in mind, share your opinion down in the comments below on whether you expect a recession next year and how do you prepare for that. I would also appreciate it if you give this video a like and share it with your friends. Have a nice day. Bye-bye.